class. Today we are going to start with the second part of the chapter, that is all the basic concepts of macroeconomics. Now these are the basic concepts wherein you are going to study about different terms. These were different terminologies you can say, and these are the most important terminologies when we study national income. Not only for this chapter, but these terms are going to be there with us for forever, because these are the terms which you use on your regular life on regular basis. So you cannot avoid these terms, right? So this session is very important in the terms of national income chapter, as well as anything which we study in future. For the entire chapter, these terms are going to be very important, because from next class probably we'll be starting with the numericals. So when we solve numerical questions, in those part, these terminologies are going to come across. So at that point of time, we should not be in the position wherein we don't remember what does the term mean actually. So that should be avoided. And how can it be avoided? If we thoroughly understand everything in this session. Okay, so I'm repeatedly saying that this is a very important session, very important terms. If at all anywhere you don't understand any of the term, you can just stop me and ask me over there. Fine. So basic concepts of macroeconomics. Let us begin with it. First term is domestic territory. I will first of all write it over here, and then I will ask you, what do you understand about this term? Domestic territory. Tell me, what do you know about this term? You might have heard about this term before also, right? I don't think so that this is a new term for us. And even if you feel that this is a new term, just give it a try, that according to you, what is domestic territory? Any idea? If you are speaking, Mridula, I can't hear you. What do we understand from the term domestic territory? Is there any mic issues? Okay, boundary of a country. Yes, very good. It is the territory or the boundary of the country. So if, say, suppose this is your country, India. This is your country, India. Then this border, outside this circle, the other countries start. Okay, other countries at the other part of the world start, but this whole circle is your country, India. Anything beyond that is not the part of our country. And within this circle, everything is the part of our country. So that is why what we will say this is the domestic territory of our country, or it is also called as economic territory. Domestic territory within the country. So domestic territory is a very important concept in national income accounting. In layman's language, it means political frontiers of a country. So it can also be called as political frontiers. Why political frontiers? Because everything related to our country will be taking place inside the domestic boundaries. Anything related to politics, anything related to government will be inside our country only. So it is called as domestic territory, economic territory, or political frontiers of the country. That means boundary of our own country. So according to United Nations, so according to UN has given one definition to economic territory. Let us see their definition. According to United Nations, economic territory or domestic territory is the geographical territory administered by a government within which a person's goods capital circulate freely. So if this is your country, India, everything inside India is going to circulate very freely as compared to the connection between the two different countries. Like, say, suppose this is India, one is USA. This is India and this is USA. Activities which will take place inside India would be much more smoother as compared to the activities which are related with US. Exporting, importing of goods and services with other countries is more difficult rather doing the exporting and importing within the domestic territories. So now you can see that with multiple names they have identified this term. Domestic territory, economic territory, political frontier, geographic territory, four different names it has. So while we study, you can come across with any of these four words. So you should know that this is the alternate term for domestic territory. The second term comes is normal resident. Very important again. While we will solve the numerical questions from national income chapter, this is going to be a very important term because as I said in the numerical questions, these terms are frequently going to come. So you should know who is called as a normal resident of the country. So normal resident of the country refers to an individual or an institution who ordinarily resides in the country and whose economic interest also lies in that country. So this is a simple meaning of normal resident. Normal resident basically means a normal person who is staying in that respective country and whose economic interest lies in that country. What do we mean by now economic interest? Any idea? What is economic interest? Normal resident is the person who is living in that country, or second, whose economic interests lie in the country. Okay, employment we can say, but not exactly. Economic interest means what? All the financial transaction of that particular person is taking place in that particular country. Now, financial transactions like what? So it can be like tax, he is receiving his income, his daily expenses. So this is economic interest. So any person who is living in that country and doing all his financial transaction in that particular country, then that person will be called as a normal resident of the country. He will be termed as a normal resident of the country. Now, normal resident include both individuals as well as institution. An individual can be said as a normal resident of the country as well as an institution, a company can also be said as a normal resident of that particular country. So first of all, normal resident means that person who lives in that country. Secondly, whose economic interest lies in that country. Talking about economic interest, it means all his financial transactions are taking place in that country, like tax to in that country. He is receiving his income in that country. He is doing his regular basis expenses and transactions in that country. So that person will be called as a normal resident. A normal resident can be an individual person or it can also be an institution. Then center of economic interest implies two things. So center of economic interest or economic interest. First, the resident lives or located within the domestic territory. That means if this is your domestic territory, then the person is living here only. First criteria is that. Second, the resident carries out basic economic activities of earning, spending, and accumulation from that location. So earning, spending, saving. if this person is doing everything related to his economic activities within the geographical boundaries, then also he will be called as a normal resident of the country. So as we said, normal resident means what? The person should satisfy two basic conditions. Then we can say that person is a normal resident. What is those two basic conditions? First condition, the person should live inside or within the domestic territory. And secondly, the person should do all the kind of economic transactions within the country itself. Economic transactions or economic activities like earning, spending, saving, everything should be done inside that country only. Only then we can say that person as a normal resident person. Now here, normal resident can be an individual person. It can also be an institution. Now followings are not included under the category of normal resident. Who all will be not coming under the category of normal resident? Example, first, foreign tourists and visitors who visit a country for recreation, holidays, medical treatment, study, sports, conference, etc. Now we said that economic interest, if any person's economic interest lies in that country, then he is a normal resident of the country. No, that is not the case. He should satisfy both the two conditions. That means he should live in that country as well as his economic interest should lie in the same country. If both the things are satisfied, then only he will be called as a normal resident. Otherwise, if we talk about economic activity, say suppose there is one person called as Ram. He lives in USA. He is coming to India for India visit for 15 days. So you will say now 15 days he is going to stay in India. He is going to spend money. He is going to do all his expenses. So now he is a normal resident of the country. No, it's not like that. For 15 days, 10 days, 1 month, 2 months, if anybody is doing financial transaction in your country, then he will not be called as a normal resident. If he is living there and then his economic interest or economic activities, daily economic activities are there in the country for a longer period of time, only then he will be called as a normal resident. So any person who is coming for as a tourist for just to see India, take a tour of our country, visit our country for any purpose, for sports purpose, for medicinal purpose, for study purpose, then he will not be called as a normal resident. Second, foreign staff of embassies, officials, diplomats, member of armed forces of a foreign country located in the given country, again they will not be the part of a normal resident. Now say suppose on Indian border, if there is any person from USA who has been shifted to India on for defense purpose, he might be in army, navy, or BSF fighters. He might be the part of fighters from India, anything like that. Just an hypothetical example. I am giving you impractical example. This does not happen really, but imagine anyone, any foreigner who has been sent to our country in order to do the work related thing. So that person will not call as a normal resident. Okay, so he will also not be the normal resident. So that was our second term, normal resident. Coming towards our third term, that is citizenship. Now this also we might have heard. We might not know clearly what is citizenship, but we might have heard about it in movies or in series. So you get a citizenship card. Now we are the citizens of India. Since by birth we are in India, we are the citizens of India. If my birth would have been taken in USA, I would have been the citizen of USA. So wherever you take birth, you become the citizen of that particular country. There is one more way to become a citizen of the country. We will see that right now. So it is basically a legal concept. So being a citizenship involves a legality or a lawful concept. It is based on the place of birth of the person or some legal provision allowing person to become a citizen. So in two ways you can become a citizen of the country. First way is by birth and second way is by government's approval or government's approval. Now, if I go to USA, I stay there for 5 to 6 years, and then I apply for the citizenship. That I want to become a citizenship of USA. Although I have shifted from India, but now permanently I want to become a citizenship of USA, and I want to live in USA. So according to the government officials and authorities, they will all discuss, decide, and there are lots of other criteria to look after, and then they will finalize whether they want to give me a citizenship or not. So if they decide to give me a citizenship, I will become a citizen of USA. And second way of becoming a citizen of the country is by birth. Wherever you take birth, you become the citizen of that particular country. And second, if you want to take a citizenship of any other country, then you have to fulfill the criteria which the government of that particular country has. It's a legal concept. Okay. So it means Indian citizenships can arise in two ways. So if in India anybody wants to become a citizen of India, then there are two ways to become a citizen of India. First, when a person is born in India, he acquires automatic citizenship of India. So first, by birth. By birth, you become a citizen of the country, citizen of India. And second, a person born outside India applies for citizenship and Indian laws allows him to become the Indian citizen. Now, for say, suppose there was one man who has come from USA in India, and now after coming to India, he has applied for citizenship from government authorities. Now, after satisfying few of the conditions, few of the things, he can become, government will finally say, okay, fine, we will give you the citizenship of India. So, two ways to become a citizen of any country. First way, by birth. By birth, you become the citizen of that particular country. Secondly, if you want to become the citizen of some other country, then in that case, you will have to apply for the citizenship card from the government officials. They will decide, and if you fit in their criteria, they will provide you the citizenship of that particular country. Okay, that was our third term, citizenship. Fourth term which comes into the picture is residentship. Now, what is residentship? See, we have heard about these words. Yeah, you might have heard it from your early age. We listen that citizen of the country, resident of the country. Okay, so see here, normal resident and residentships are two different things. Do not get confused between them. Normal resident is different, residentship is different. You are called as normal resident, or you will be called as a normal resident if you are living there first. Secondly, if your economic interest lies in that particular country, then you will be called as a normal resident. Citizenship also, we saw that there are two ways to become a citizenship of any country. First, you have to be born in that country. Secondly, you have to apply for the citizenship card from the government officials for from that particular government authority. And then accordingly, if you satisfy their conditions, they will give you the citizenship card of that particular country. Next comes is residentialship or residentship. Now, when we studied citizenship, I said, when we studied citizenship, I said it is a legal concept. But when we study residentship, it is a economic concept based on the basic economic activities performed by a person. Okay, residentship is based on what? It is based on the economic activities which are being performed by a person. Economic activities, those activities which involve exchange of money. So residentship is an economic concept since it focuses on the economic activity of the individual. So an individual is a normal resident of a country if he ordinarily resides in the country for a period more than 1 year and his center of economic interest also lies in that country. So who will be the resident of the country, or who can be called as a resident of the country? Any individual who lives in the country for more than 1 year. And secondly, whose economic interest lies in that country. That means now that person is living in our country for more than a year, and his all savings, income, spending is also done in the our country only. See, because see, when we saw the citizenship, when we talked about non-resident, we said that these are the few examples which will not be considered as the resident of the country. They will not be the resident of the country. But if any person who stays in our country for more than a year, now he is doing everything in our country. His entire economic interest is lying in our country. That is savings, income, spending, expenditure, everything is in our country. Then finally we can declare him as a resident of the country, residentship of the country. So citizenship is a legal concept. Because why it's a legal concept? Because the approval is going to come from government authorities, government officials. But if we talk about residentship, then it completely depends upon the economical activity performed by an individual. So who can be the resident of the country? Any person who stays in the country for more than a year and his economic interest also lies in our country, that person will be called as a resident of the country. Now they have given you one example. A Chinese living in India for more than 1 year is a normal resident of India. However, he is a non-citizen or national of India as he does not hold citizenship of India. It means a person can be citizen of one country and at the same time a resident of another country. So he is a citizen from China, but his residentship is of our country, that is India. So just understand the example very properly. There was one Chinese boy who was staying in our country, India, for more than 1 year. And recently we studied that if anybody stays in our country for more than 1 year and his economic interest lies in our country, then that person becomes the resident of the country. But will he become the citizen of the country? No, because he is not satisfying both the conditions of the citizenship of the country. That means he has neither born in India, neither he has applied for any citizenship card from the government. So he is not yet the citizen of the country. But can he be called as a resident of the country? Yes, definitely he can be called as a resident of the country because he is satisfying both the conditions of residentship. That is, first, he has lived in India for now more than a year, as well as his economic interest is completely lying in our country. So, he will be called as a resident of India, but he will not be called as a citizen of India. And he will be called a citizen of China. So, you can see at the same time, one person can be resident of one country and the same person can be a citizen of some other country. Fine. So basic difference between citizenship and residentship. The citizenship is a legal concept because it involves government officials, government authorities. Whereas, whereas residentship is an economical concept because it involves economic activity of the person. Am I clear till here? Any doubts? Anything you didn't understood? Normal resident, we saw normal resident, we saw citizenship, we saw residentialship, and we saw domestic territory. Any doubt from any of the words which we completed? Domestic territory, normal resident, then citizenship, residentship. Should I go from on next term? Yes, Mridula, no doubts still here. Any doubts? Should I start with the next term? Mridula, are you there in the session? So please reply if you have any doubt. Let me know. If not, then we will move ahead. Should I continue with the next term? Starting terms, four terms we have already seen. Non-resident, residentship, citizenship, and economic territory. Next term is factor income. Can I continue with it? Okay. Okay. Factor income. Again, a very important term because this term is going to be there very frequently when we solve numerical questions from this chapter. So factor income refers to income received by factors of production for rendering factor service in the production process. So what is factor income? Factor income is nothing but the income received by the factors of production while doing the production process. So that is called as factor income. So it's received for providing factor services of land, labor, capital, and entrepreneur. What is the return we get from land? What do we get from land? Okay, we get rent. From labor? Yes. Capital? Very good. Interest. And from entrepreneur? Profit. So these are basically nothing but the income received after providing the factor services. So that is why they are called as factor income, and this is what factor income is. After giving the factor services. Factor services are the services which we provide during the time of production process. Those are called as factor services. And after providing those services, we will get something in return. We know that. So that return is called as factor income. So factor income, rent, wages, interest, and profit are nothing but the factor incomes. So factor income of normal resident of a country are included in the national income. Example, rent, wages, interest, and profit. These are called as factor income, and these income are included in national income. These incomes are included in national income. You will understand this more thoroughly when we will start solving the numerical questions. In that, when we will study the different methods of national income, you will be getting more clearer that how these factor incomes are considered while calculating national income practically. So factor incomes are what? Factor incomes are the income received from providing the factor services during the production process. So factors of production are the primary inputs which are needed to produce goods and services. So all the factors of production are termed as primary inputs. Very important for factual question. Factors of production are called as primary inputs. Why primary inputs? As I said earlier also, there are so many different factors of production which are required for doing the production process. But these four are the most important factors of production, you can say, and that is why they are called as primary inputs. So factors of production are broadly classified into four heads. land, labor, capital and interest. So these are nothing but factor services. Then what would be factor income? So factor income are rent, wages, interest and profit. These are the factor income and this is what factor income is. And factor income will always include in national income. That was our next term, factor income. Now let us move towards our new term, another new term, that is transfer income. Now what is transfer income? So transfer income refers to income received without rendering any productive service in return. So if anybody gets any kind of money, but in return that person is not providing any kind of goods and services, then such kind of income are called as transfer income. Now say suppose this is Ram and this is Ram's parents. So it is the birthday of Ram. So Ram's parents gave him 100 rupees. In return, Ram is not going to give any kind of goods and services to his parents. So this kind of income will be termed as transfer income, wherein only the person is giving you some kind of monetary terms, money, but in return you will not give that person any kind of goods and services. In return you will be not giving them anything, but still you are receiving money. So that those kind of income, this 100 rupees is an income from, so this kind of incomes are called as transfer income. Remember, factor incomes are those incomes which you are going to get from factor services or factors of production. That means there you are providing some kind of services and in return you are getting the money. So those kind of income are called as factor income. But under transfer income, you are just getting the money. In return, you are not giving any kind of goods and services. Then those kind of incomes are called as transfer income. Now say suppose today my mother will come and give me 200 rupees. And in return, I am not going to give her any good or any services. So those 200 rupees will come under what? Will come under transfer income. But say suppose I am an entrepreneur, I have 4 laborers working for me, I give them 200, 200, 200 each, then that will be of what kind of income? It would be a factor income. So transfer incomes are also called as unilateral incomes or one-sided income, because it's a one-sided concept. One person is giving you money. In return to that money, you are not providing any kind of goods and services to that person. So those kind of incomes are called as transfer incomes. And it is very important. It is not included in national income as it does not reflect any production of goods and services. So factor transfer incomes. Transfer incomes will never be included in national income because this exchanging of money is not involved in economic activity or in any production process. So if any activity which is not an economic activity or which is not impacting the economy of the country, then those kind of activities are not considered while computing national income. So remember this, when numerical questions they'll give you transfer income 200 rupees. So you should know that transfer incomes are not supposed to be included while calculating national income. And why we do not calculate them? Because they are not impacting the economy. They are not involving in any kind of production process or productive process. That is the reason we will not include transfer incomes. Factor incomes, if I compare it with factor incomes, say suppose I give wages to laborers. I'm giving wages to the laborers. So this will be included in national income? Yes, of course. Because what does this laborers doing? These laborers are doing the production of goods and services. They are manufacturing the goods and services. Production or manufacturing of goods and services will definitely include in national income because it is impacting your economy, and we know production is an economic activity. So as I said, any economic activity will be considered in national income, but non-economic national income. So transfer incomes are basically those kind of non-economic activity which will be one-sided, and that is why they are also called as unilateral concept or one-sided concept. Only one person is giving the money. In return, the other person is not providing any kind of products or any kind of services. So such kind of incomes are called as transfer incomes. It can be received either within the domestic territory of a country or from abroad. Now, how from abroad? Say suppose from abroad, within the domestic territory also it can take place. It can take place from abroad also. So say suppose these are the two countries. Okay, brown is India and pink is USA. Now here there is boy called as Ram. Here there is one boy called as Sham. They both are friends. Fine. So what does Sham do? Sham is transferring 200 rupees. Now of course this is in dollar. It is going to be in rupees. Fine. So let us consider it in Indian rupee only. We will not go in dollar rupee exchange rate and all right now. We are going to study about it in your last chapters, but then we will see. Right now just understand that Sham wants to transfer 200 rupees to Ram as a gift. Now he transfers this 200 rupees to Ram as a gift. In return, Ram is giving nothing, neither goods, neither services. Ram in return is giving him nothing. So which kind of income it would be? It is a transfer income for Ram. Why? Because Ram is getting this money for free of cost. He is not providing any goods or any services to Sham. So this can happen abroad with abroad countries, or it can happen within the same country. Same country means what? Say suppose, take same example, this is Mumbai and this is Tamil Nadu. Now here Ram is there, here also Sham is there. Ram is transferring 500 rupees to Sham. Sham is transferring 500 rupees to Ram. And in return, Ram gives him nothing. No goods, no services. So again, this is a transfer income for Ram. Because Ram is not going to provide any kind of goods and services to Sham. Sham is just giving him the money as a gift, as a token of love. So what he will do? He will not provide any kind of goods and services. That means no economic activity is taking place over here. Nothing is getting produced in the economy. Nothing is getting manufactured in the economy. And that is the reason we will not include it in our national income. So always remember, transfer incomes are never included in national income, but factor incomes are always included in national income because factor incomes are the incomes which are generated out of providing services. Transfer incomes are just the one-sided incomes or the unilateral incomes. Now same way as I took the example of Ram and Sham, it can be the government, Indian government and USA government. Say suppose USA government donates money, gives donation to Indian government. There is also again a unilateral transfer which will come under transfer income because it is just a donation. India in return will give nothing to USA, no goods, no services, nothing. So this donation will also be the part of transfer income, and this donation will also be not included while computing national income. Okay. So that is what they have seen. It can be happening within the domestic territory. It can also take place with the foreign countries. Examples. Now, what are the examples? Old age pension, scholarship, unemployment allowance, pocket money, etc. Taxes received by the government are transfer incomes of the government as they are received without providing any productive services in the return. We know that we pay taxes to government, right? So these taxes are the part of transfer income because when we pay taxes, now say suppose I go and pay tax to government. Government will say, okay, fine, Ritika, what do you want? Tell me, I will provide you that good or that service. No, government will not say that because government does anything for each and every individual living in the country, each and every person living in the country. It is not going to do any favor or any welfare for the individual person. Whatever government does is for the entire country, for the entire nation. So the tax which we pay to the government is the kind of transfer income because in return government is not going to individually provide any goods or services to me. Same way, subsidies paid by the government are transfer payments of the government. Same way, subsidies are what? Discounts which government gives to poor people basically. Those are also transfer payment because they give subsidies, but in return, poor people are not going to give them any kind of goods and services. Poor people are not going to give any kind of goods and services to government. So, subsidies are also the part of transfer income. Now, transfer receipts or transfer income can be again of two types: current transfer, capital transfer. Okay, so let us see what is current transfer and what is capital transfer. Current transfers are made from income, whereas capital transfers are made from the wealth of the payer. So, current transfers are made from the income which we are receiving at present, whereas capital transfers are made from the wealth of the payer means from the savings basically. In easy terms, it means from the savings. Now, suppose my income is 100 rupees and my saving was 200 rupees. In situation 1, I have made the payment or I have made the expenditure from this 100 rupees for 20 rupees. So this type of payment will be called as current payment. Whereas in situation 2, I am paying 100 rupees from my savings, which I have done in past. Then in this case, this payment or this expenditure which I have made will be called as capital transfer. Okay, I hope you get the different basic differentiation between current transfer and capital transfer. Current transfer is done from the present income, from the present money which we are earning, whereas capital transfer are done from the wealth of the person or from the savings of the person. It is not received at present. Okay, that was the first basic difference between current transfer and capital transfer. Second, current transfers are generally regular in nature, whereas capital transfer are irregular. Yes, so whatever spending you are going to do from your income. That is your current transfer. Savings, you will take out your savings very rarely, right? Not on regular basis you can spend from your savings. On regular basis you will be spending from income, and on some occasions you will be spending from your savings. So in that is why current transfers are regular in nature, because you are also going to receive this regularly, whereas savings are irregular in nature. They are not regular. Here the spending from savings will be done very irregularly. Third, current transfer are meant for consumption purpose, whereas capital transfer are meant for capital formation. Just for an example, take, okay. Now, when your parents, okay, consider your parents want to do the consumption of regular goods like purchasing rice, wheat, grocery, vegetables, fruits. So for that, it is but obvious that they are going to spend from their income, whatever income they are getting, they are going to spend from that income. Very obvious. But now just imagine your parents wants to invest or purchase a house, purchase a car, purchase air conditioner, or purchase washing machine, purchase bike, any such kind of thing. Then what your parents will do? Your parents will say, okay, now I have to see how much savings do I have, and from that savings I will take out some money and then purchase this particular thing. So what from this we come to know? We get to know that our regular consumptions are done from current transfers, whereas or if we want to purchase or do capital formation, we want to purchase heavy capital, then in that case we will have to take out our wealth or savings. That means our capital transfers. So current transfers are always done for the consumption purpose, and capital transfers are always done for the capital formation. All of these things are called as capital formation. If I purchase a house, I have done the capital formation. It's a capital for me. It's a money for me. How? Because in future, if I want to sell that house, I'll be receiving that many amount of money. So it's a capital for me, and that is why it is called as capital. Now, examples of current transfers. So old age pension, gifts, unemployment are the current transfers, whereas capital transfer means if you are investing in grant investment means if you are investing in donation or anything, capital gains tax, if your war damages, if any kind of damages has been done. Now from the government's end also, government also receives income and government also has savings. So if there is any natural calamity had taken place in the economy or in the country, like war or famine or drought, then in that case, what government will do? Government will take out the money from its saving and then try to normalize the situation of the economy of the country. So that is what your capital transfer. So current transfer and capital transfer. Is everything clear till here? Any doubts? Anything you didn't understand till here? If you want, I will just say quickly what all terms we have already studied. We have talked about domestic territory, then we did normal resident, then we understood citizenship, then we understood residentship, then we saw factor income, then we talked about transfer income. In transfer income, we said the transfer income can be of two types. It can be a current transfer, it can be a capital transfer. Current transfer means those activities or those transactions which are done through your regular income, and capital transfers are those transfer which transactions you are doing for capital formation. Any doubts still here? Anything you didn't understood? Oh, perfect. So we'll see more few one or two terms, then we'll take a break. Next term is final good. Now this is also a not new word for us. Final good, with the name itself we can understand final good means the good, which is final, which is ready to use good, which is ready. Now the consumers can use that good. So final goods refers to those goods which are used either for consumption or for investment. So final goods are going to be those goods which can be either used for consumption purpose or which can be used for investment. Now say for suppose there is a house. Okay, there is a house which is now the construction of that house has been done. Now that house is ready to use. I am purchasing that house, but I am not living in that house. I will give that house on rent. So basically that's an investment for me. I have done the investment of a final good. And say in the second scenario, say suppose I have purchased that house and I am living in that house. So I have done the consumption of that house. Okay, consumption does not only mean eating that thing. Okay, we consume electricity, then that does not mean you are eating that. Okay, so consumption, never make an assumption that consumption only means eating or anything. No, anything which we are utilizing is called as consumption. Consumption of water, consumption of electricity. So here consumption of final goods. So either you can consume the final good, or second option you can invest in that final good. Final goods include goods purchased. Final goods include two different types. First, goods purchased by consumer households as they are meant for final consumption, like milk purchased by a household, chocolates purchased by households, hair oil purchased by a household, vegetables purchased by a household. So goods purchased by consumer household are meant for final consumption. So final goods का first thing can be any good which is purchased for consumer household for final consumption, like consuming chocolate, hair oil, vegetables, fruits, milk, etc. Secondly, goods purchased by firms for capital formation or investment, like machinery purchased by a firm. Second thing, it can be if at all there is any firm who is purchasing machinery, land, building for investment purpose. For investment purpose. So basically they are forming the capital as well as they are investing it. They have done the investment. So the final goods ka consumption can be in two different forms. Now it must be noted that final goods are neither resold nor used for any further transformation in the process of production. Whatever the final goods you buy are never resold or they are never used in any further production process. For now, suppose if you are purchasing a hair oil, then that hair oil is not going to come in help for production of any goods, right? So finally you in the production process of any other good, as well as it is never resold. So that was final good. Next term is intermediate goods. Now what are intermediate goods? So with the name itself you can understand intermediate means they are in a middle position right now. They are not completely might be ready for the usage or for the consumption purpose. That kind of good are called as intermediate goods. So intermediate goods refers to those goods which are either used for resale or for further production in the same year. So intermediary goods, also termed as capital goods. And final goods are also termed as consumer goods. So intermediate goods or capital goods are those goods which are used for further production process, or else you can do the reselling of that particular good. Such kind of goods are called as intermediate goods. Okay, now they are not completely ready to use. They are going to be used in the further production process of the good or either for the reselling of goods. So intermediate goods include, what does it include? Let us see. Intermediate goods include goods purchased for resale like milk purchased by a dairy shop. So if a dairy shop person is purchasing a milk, then he is going to resell it because he is going to prepare a tea or coffee for the consumers and then give it to the consumer, right? So as of for him, that milk is an intermediate good which he is going to use for the further production process of the goods. So goods purchased for a resale, that is milk purchased by a dairy shop, will be a intermediate good. Now, such kind of questions are expected in your exams. When we will solve the questions, I'll also get these kind of questions so that you will get an idea, rough idea that what kind of questions are expected. You have to identify that which good is a consumption good, which good is an intermediate good, which good is a final good. Likewise, you have to examine, identify, and at times they also ask for the reasons. So you have to know, if say suppose they will give you one sentence, milk purchased by a dairy shop, is it a consumption good or is it a final good or is it an intermediate good? So you should know milk purchased by a dairy shop is an intermediate good, but milk purchased by an individual is a final good. Fine. Second, goods used for further production process like milk used for making sweets. So again, if a sweet shop person is taking milk for preparing sweets from that milk, then that again what he is doing, he is making use of the good for the further production process. So any good which is used for the further production process is called as intermediate good. So anything, any person purchasing milk for making sweets will be also coming under the category of intermediate good. Few important points about intermediate good. First, they are generally purchased by one production unit from another production unit. That is, intermediate goods remain within the production boundary. So one production unit to another production unit means production. Milk producer will give this milk to the sweet producer, and this milk is still in the production boundary because it is going to get used in producing the sweets. Investment or capital formation refers to addition to the capital stock of an economy. When we say investment, when we talk about investment, we say that investment is done for the capital formation, or that investment is going to form a new capital that can be in the form of land, building, machinery, equipment, tools, etc. Now, a very important thing I will tell you over here only because it's an important information which you should know from the start. When we talk about investment, we know what is investment, right? We know what is investment. Investment means nothing but putting your money, putting your capital in order to form something, right? Waste and invest, two terms are there. Waste means you are spending your money on something which is not going to give you any kind of benefits in return. Whereas investment means what? Investment means you are spending your money on something which is going to give you benefits in return. Example, if I purchase a Barbie doll, then that becomes a waste of money. But at the same time, if I purchase a machinery, that is an investment because that machinery is going to give me benefits in future. How that machinery is going to give me benefits? By producing more and more units, by helping me in manufacturing the goods. That machinery is going to help me. So it's an investment for me, right? So investment is something wherein you spend your money so that that particular thing will give you returns in give you benefit in returns. Now, when we talk about investment, investments are usually classified into two broad categories, or you can say are of two broad types. First, it can be a financial investment. Secondly, it can be a capital investment. Financial investment means investing your money in securities. Securities, that means in the form of shares, bonds, debentures, equity shares, preference shares, like that. Capital investment means investing on land, building, machinery, equipments, tools, etc. So when we study economics, our complete focus is going to be there on capital investment. In economics, we do not talk about financial investment. Financial investment you will be studying or talking about under financial subject, your accountancy subject. But when we study economics, we do not talk about financial investments. We only and only focus attention on capital investments. Fine. So investment is something wherein you spend your money in order to get benefits in return. And that investment can be of two types. It can be a financial investment. It can be a capital investment. Financial investment means investment in securities, debentures, equities, preferences, bonds, etc. Capital investment means investing money in land, building, machinery, equipment, etc. In economics, we will be only bothered about capital investment. We'll be only talking about capital investment. If you have been concentrating in the lecture, you might have understood that till now, wherever we have used the investment term, we have talked about capital formation. But in accountancy and all, you will study both the kinds of investment. It can be a financial, it can be a capital investment. But in economics, our prime focus is on capital investment and not on financial investment. So investment or capital formation refers to the addition on the capital stock of the economy. So basically, it will increase the stock of capital in the economy. Example, construction of building, purchase of machinery, addition to inventories of goods. All of these are the examples of capital investment or capital formations. Investment can be looked up into two forms, basically gross investment and net investment. Very important. Investment can be of two types. It can be a gross investment, it can be a net investment. Before moving towards the term gross investment and net investment, let us understand what do we mean by gross and what do we mean by net. Gross means nothing but the actual value, whereas net means the deductions done from the actual value, and the total money which is remaining in our hands is called as net. Example, we know that when a person receives a salary, when a person receives an income, the person has to pay certain amount from its salary as a tax, right? So say suppose the income of the person or the salary of the person is 500 rupees. As I said, I am going to take all the hypothetical examples or impractical examples. In examples, don't go in detailing and feel that how come anybody can receive 500 rupees and all. It's an impractical example. I am taking small amounts so that we can understand the example. If I take 5 lakhs, 6 lakhs, 10 lakhs, then it will confuse us. Okay. So just understand the concept. Try to understand the concept. We all receive income and salary. Income is 500 rupees. So this 500 rupees is nothing but the gross value. Now, as I said that, see what is tax, how it is removed from the salary, just leave this apart. Just understand this much, that when a person receives a salary, there is certain amount of money which gets deducted as tax. So say suppose here also the amount is getting deducted as tax, say suppose 100 rupees is getting deducted and in the form of tax. So remaining is 400 rupees. So this 400 rupees will be termed as net value. So the total amount, total money which is received or which are there in our hands after doing all the deductions are called as net value. Whereas gross value, see, you have understood, I am assuming you have already understood the concept of these things in your accountancy subject. So I should have not gone in so much of detail or in depth, but still I will just explain you. In when the actual amount, the actual money which you have in your hands is the gross value, gross amount. After doing all the deductions from that amount, like tax as an example we took, there are so many deductions which are done from the salary. If we include all the deductions, and then the total amount which is left in the hands of the person is called as net. Fine. Now we understood what are the terms gross and net. Gross means the actual value, and net means the uh, after the deductions, the amount which is left with us is the net value. Now let us understand in the terms of investment. What is gross investment? So gross investment is addition to the stock of capital before making allowance for depreciation. See, now I gave you an example wherein I said that uh, tax, I took it as a tax. But now let us understand it from the terms of depreciation. Now I hope you know what is the meaning of depreciation. What do we mean by the term depreciation? If you are typing in the chat box, type it. Fall in the value of fixed assets. Very good. Perfect. So now say suppose I purchased a mobile phone. I have purchased a mobile phone which was for rupees 500. So this 500 is nothing but my gross value or gross investment which I have done. Okay, purchasing of a mobile phone is an investment for me. So I have done the gross investment of 500 rupees. Now, as we know, there is a fall in the value of fixed assets on a regular basis. Now, after a month, I feel that I want to sell this phone. But of course, since it's a asset, it's a asset, so there is going to be a depreciation with time in the asset. So now, the value of the asset has been depreciated by 100 rupees. So when I sold this phone, I got 400 rupees after selling the phone. So this is what my net value on return was. So the total amount remaining in my hand after deducting depreciation is called as net value. And the actual value of the product is called as gross value. So before making any kind of allowances is nothing but the charges or the deductions. Allowances means the deductions which can be in the form of tax, which can be in the form of depreciation, which can be form of anything. Fine. So the total value which is the total amount which is there in the hand of the person before making the allowances like depreciation is called as gross investment. So capital stock consists of fixed assets and unsold stock. So capital stock will include what? All the fixed assets as well as the assets which has not been sold yet. So gross investment is the expenditure on purchase of fixed asset and sold and unsold stock during the accounting year. So of course, if in a year your product has been unsold, it has not been sold, then gross investment nothing but the expenditure on that particular product. So gross investment does not indicate the actual change in the economy's stock of productive asset for the given year. During production process, some amount of fixed capital is used up. The loss of fixed capital is known as depreciation. The loss or the fall of value, see, the goods are in stock, goods are there in warehouse, they are kept as it is, they are not been sold yet. So as we know that all the fixed goods or fixed assets, the value of fixed goods or fixed assets keeps on falling. So they are going to we are going to get the allowances of depreciation, right? Because the goods which are there in the warehouse, their prices are going to fall now because they are in the warehouse from a very long time. So that deductions is called as nothing but depreciation. So the value is going to get depreciated. So by subtracting the depreciation from gross investment, we get. So that is what they are saying, that after subtracting the depreciation from gross investment, we will get net investment. And second is net investment. So the actual addition to made to the capital stock in the economy period is termed as net investment. Net investment minus gross investment is equals net investment, gross investment and depreciation. Three important terms. Now they have explained you what is depreciation also in a detailed manner. So before going further, let us just take 10 minutes break. Okay. Just if you want, you can revise whatever we have done till now in the session for 5 minutes, and then 5 minutes you can get freshen up. And if you want to get fresh, then that is also fine. 10 minutes, take a quick break, and then we will be back again. Okay, 7:19 it is, 7:29, be here. Okay, shall we continue? You there, Mridula? Shall we continue? Yes. Okay. Perfect. So we talked about final goods, intermediate goods, after which we started talking about investment. Under investment, we said that it can be a gross investment, it can be a net investment, wherein I said that gross investment is the actual value of investment, And net investment is the value which remains with us after the allowance deductions like depreciation. Then we said that let us understand the meaning of depreciation very carefully or very nicely. Depreciation is consumption of fixed capital. So you can call it as depreciation, you can also call it as consumption of fixed capital. So depreciation refers to the fall in the value of fixed assets due to normal wear and tear. So as you said, depreciation is nothing but the falling of the value of fixed assets. Like usually when we purchase a fixed asset, after a certain period of time its value starts decreasing, and that decreasing value is called as nothing but depreciation after passage of time or expected obsolescence change in technology. So usually the basic reason of normal wear and tear is also due to the elongated time. Maximum minimum a lot of time has been done of that product. Expected obsolescence change in technology. That means that product no more exists in the present economy or in the present situation because it is out of technology. The technology is outdated. So that is the another reason. Concept of depreciation is very important to differentiate between gross value and the net value. Gross is inclusive of depreciation, whereas net is exclusive of depreciation. So basically we know that what is gross and what is, we already studied that what is gross value and what is net. So gross is the actual value or the value before the deductions, and net is the value which we get after the deduction. So when you do gross minus depreciation, you get the net value. And if you do net plus, small change over here, how will you get gross value? When you are doing net value plus depreciation. Likewise, if you want to find out the net value, what you have to do? Gross minus depreciation. So gross is the actual value before the deductions are made, and net is the value which is made post deductions, allowances like depreciation. Fine. So here very important, because from next class we are going to start with the aggregates of national income, and the aggregates of national income we are going to study about the same thing, and on basis of this thing we are going to solve the numerical questions. So like what gross and net is the determinants. Gross and net is dependent upon the depreciation. Gross is the actual value. When you remove depreciation from that, you get net value. Same way, if you add depreciation to net value, you will get gross value. Next important term which comes into the picture is NIT. NIT is nothing but net indirect tax. Okay, net indirect tax is the form of taxes which we pay. So net indirect tax refers to the difference between indirect tax and subsidies. So how do we get NIT? NIT we will get IT minus subsidies. IT is nothing but indirect tax. Tax basically can be of two forms. It can be a direct tax, it can be an indirect tax. Indirect tax has been now replaced with the term GST, that is goods and services tax. So now I'm not going in detail what is indirect tax, what is direct tax, nothing. Just understand that tax are of two types, direct tax, indirect tax. Indirect tax has now been replaced with a new term called as GST, that is goods and services tax. So when you will solve the numerical question, at times they will be using the word IDT, that is indirect tax. At times they will be using the word GST. See, there is lots of alternative names for each and everything, which we need to know, because at times what will happen, we know the one name, we don't know the alternative names, and that is why we will not be able to solve the numerical question or answer any question. Alternative names are very important for your any subjects because there are lots of alternative names of it. So just understand tax is nothing but direct tax and indirect tax, two forms. Indirect tax is nothing but GST, that is goods and services tax. Now what is NIT? How you will get NIT? NIT you will get from indirect tax minus subsidies. Indirect tax is only nothing but GST minus subsidies. Subsidies is nothing but the discounts which are given by the government to the poor people. Even though it is free for the poor people, but government do get, it's an expense for the government. For say suppose poor people, government. Now for poor people, LPG gas cylinders prices are very high. They cannot afford it. Say suppose the price of the LPG gas cylinder is 200 rupees, they cannot afford it. So what will government say? Government say, okay fine, since you all are poor, instead of 200 rupees, I will give you the same LPG gas for 100 rupees. So this is the subsidy which government is providing to poor. But actual value to is 100 rupees. But poor people is paying only 100. Then remaining 100, what about this remaining 100? So this remaining 100 will be paid by the government for those poor people. So for government, this is an expenditure. Okay. So that is what they are saying over here, that IT is the indirect tax minus subsidies. Subsidies are the discounts which are provided by the government for the poor people. In next class, we are going to study all of these things in the formula format. Okay, so that is why for now it is important for you to understand the terms. If you are able to understand the terms, in the next class, I will be starting giving you the formulas, and on the basis of those formulas, we will be starting to solve the numerical questions, basic numerical questions of national income. So very important. Continuously, I am saying these terms are very important. It is going to be there for you in the for the entire chapter. So pay attention to it very properly, and if you have not understood any term, any word, get it clear from me right now. Because in the next class, all these formulas we are going to use. IT minus subsidies, gross minus depreciation is equals to net, net plus debt is gross. All these things we are going to use it. Okay. And also from next class, you will have to carry your books because we will be solving sums. So for sums, I need proper pen, pencil and scale. So that anywhere if you have to draw the format, then in that case you should have your every stencil, every stationery kit. Now indirect tax. So as we said that net indirect tax or NIT, net indirect tax or NIT is situated with IT minus subsidies. IT is nothing but indirect tax, which is also called as GST. Fine, which is also called as GST. So let us first understand what is indirect tax. Indirect tax refers to those tax which are imposed by the government on production and sale of goods and services. For example, GST. So GST is basically on the production of goods and services. See, if you all might have visited to a restaurant or a movie theater, you all get a invoice, a bill. Once you do the payment, you get a bill of it. Okay. If you go to a restaurant, movie theater, if you buy a mobile phone, you buy a washing machine, laptop, you get a bill. When you get a bill, you will see in that bill there is something called as GST. 9% GST, 8%. Like this, you will see one column, one line wherein they will be specifying the GST. If you have not done till now, then please make sure that from the next time you are going to observe this. Okay, in your purchase of any heavy machineries like laptop, TV, washing machine, mobile phone, Or also for that matter, if not that, then you go to a theater, movie theater, restaurant, they will charge you GST. So GST or indirect tax is nothing but the taxes which the government is going to charge on the manufacturer for the production of goods and services. So indirect tax increases the price of the product in the market. For example, if cost of producing one set of speaker is 500 rupees and government levies GST of 10%, then the price of speaker will increase to 500 due to indirect tax. So basically what they are saying, if say suppose the price of the speaker is 500, but government imposes GST for say suppose 100. Actual price of the speaker was 500, but since GST has been imposed on it, the price of the product now becomes 600. So you will get the product for 600. Now if you, again you all have done Zomato, okay, if you have done online booking of food basically, when you order online, you will see that when you add cart, add dishes or add any item in your cart, it might be showing 300 rupees. But when you at the end click for payment, it might becomes 380 rupees. Then what is this 80 rupees? Apart from delivery charges, it also includes GST. So because of GST, the price of the good increases. And second is subsidies. Subsidies are the economic assistance given by the government to the firms and households with a motive of general welfare. So subsidies, the motive of providing subsidies is welfare and not the profit motive. Subsidies are provided by the government. Subsidies can be provided to the firms. It can be also provided to the individuals. It's up to government. If it wants, it can provide subsidies to the firms, or if it wants, it can provide subsidies to the individuals. In India, LPG cylinder is sold at subsidized rate. So as I gave you an example, that since LPG becomes very expensive for the poor people, it is not affordable by them. So in that case, what will government will do? Government will provide the LPG gas at subsidized rate. Instead of 200, it will say that okay, since you are poor, you pay only 100 rupees. Then where remaining 100 rupees will come? 100 rupees, remaining 100 rupees government will have to pay. So it's an expense for the government. Providing subsidies is an expense for the government. It refers to the difference between factor income received and it, it refers to the difference between factor income received from the rest of the world and factor income paid to the rest of the world. Now again there comes a new term, NFIA. On the basis of this term also we are going to solve numerical questions. What is NFIA? NFIA means net factor income from abroad. So here we are going to include both exports as well as imports. Net factor income from abroad. How do you find the actual value of NFIA? So the actual value of NFIA is factor income from abroad minus factor income paid to abroad. How much money, how much factor income? See, factor income, recently we studied while we were learning the terms, we were discussing the terms. That time we saw one term, factor income. Factor income means what? The income, the money which we received from providing factor services, that is your rent, wages, interest and profit. So those are factor income. So how much income you are earning from abroad minus how much payment you are doing to abroad is called as NFIA, that is net factor income from abroad. Say suppose mm, you have done exporting of goods. Exporting of goods means what? Selling of goods to the foreign country. since we are doing selling, so we will receive the income. Say suppose we have received the income of 200 rupees. At the same time, we have done importing of goods and services. Importing of goods and services means what? Buying of goods and services. Since we are buying the goods and services, we might have done the payment. Say suppose we have done the payment of 100 rupees. Now from this information, we have to find out what is net factor income from abroad or NFI. So we know NFIA is equals to factor income earned from abroad. So how much do we have earned from abroad? 200 rupees minus factor income paid to abroad. So how much do we have we paid to the abroad? 100 rupees. So here comes 100 rupees. So is equals to 200 minus 100 is how much? 100 rupees. And this is nothing but my NFIA, that is net factor income from abroad. Okay, so net factor income from abroad is nothing but the difference between exporting and importing of goods and services. Exporting, selling of goods and services. When we sell goods and services, we are going to receive income. So 200 rupees we have received. When we import goods and services, import means what? Buying and selling of buying of goods and services. So when we buy goods and services, of course we have to do the payment. If I am buying a pen from you, I will have to do a payment to you. So that is buying, that is importing. So when country also does buying of goods and services, they will have to pay money to the foreign country. So say suppose 100 rupees. So if I have to find out NFIA, 200 minus 100 is 100 rupees. Simple. Done. So basically three very important things we have to understand. Gross net investment, depreciation, net indirect tax and subsidies, NFIA, net factor income from abroad minus factor income paid or to abroad. Three things very important. In the next class, when we start with aggregates, these three things only are going to help you. And not only for aggregates, when we will start doing numericals for methods of national income, at that point of time also, these three things are going to help you. So these aggregates are these three things are going to help you to the all the time for solve any question related to national income. Any method, any question related to national income, if you want to solve, these three terms are going to be very useful, and they are going to be there. Fine. Any doubts till now? Any doubt in today's session? Anything you didn't understood, or you want me to repeat anything? No, all clear. Very good. So what you will do today, you will go revise everything. See if you have any doubt anywhere. So the next class you can come up with the doubts. And if not, then we are going to start with the numerical question from the next class. So carry a book, pen, stationery, all your stationery kits, and also numericals are going to be very interesting. So we'll be doing that on the next class.